Please stay tuned after the conclusion of the podcast for additional important information. Hello, everybody. Welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to financial advisors and their clients. My name is Greg Hall. I lead the U.S. Wealth Management business here at PIMCO. And as usual, I will be your host for today's discussion. Today's topic is something I'm really excited about. And you know, I'll tell you what it is. It's commercial real estate, opportunities in commercial real estate. And it occurred to me as we were preparing for the episode today that I'm surprised we haven't tackled this topic already. Real estate in general is, of course, very important to most, two-legged investors, most of your clients, if you're financial advisors. And then investing in real estate professionally as an asset class has really been one of the key themes within wealth management over the last, shall we say 10 or 15 years. But of late, given some of the changes in the market and evolution of the market cycle, I hear it being talked about less and less. It's sort of fallen out of conversation. When I go to conferences, it used to be topics 1 through 5 on the agenda, opportunities in real estate, for individual investors, and that seems to have died down somewhat. And we're going to talk about why that is. But I just note here at the top of the conversation that sometimes when the noise level around an opportunity set diminishes, that's a signal that there are terrific opportunities available there. And we think that might be the case right now within real estate. Certainly not a straightforward story, not a story without its twists and turns and nuances, which is why I've surrounded myself today with some experts in the field. So joining me for today's conversation, Russ Gannaway, who's a managing director here at PIMCO. He has grown up in the real estate business here with us across both the public and the private side. He's a senior portfolio manager involved in many of the funds where we invest in real estate assets, both debt and equity, public and private. He's truly looking at the full panoply and full spectrum of real estate opportunities. So Russ, it's awesome to have you here. Thanks for joining us.
Thanks for having me.
With Russ, I've got the pleasure to introduce you to Seray Incoglu. Seray joined us a little bit more recently than Russ. She's fully focused on the private side. She focuses on originating and managing loans to real estate owners on the private side of our business. Seray, thank you for being here and being part of the conversation.
Yeah, it's great to be here, Greg.
And then, as always, we have one of our account managers who works directly with financial advisors. Joining for the conversation. He's here to represent your questions, your interests. Gino Gabbianelli, covering the city of New York for PIMCO, a fine real estate-driven city. So we figured you were the right guy to have with us. But Gino, thanks for joining us.
Thanks, Greg. Delighted to be here.
Can I ask each of you guys just to really quickly and kind of introduce yourselves in terms of your path, of how you got to PIMCO, why you're sitting at the table here? Russ?
Sure. I've been at PIMCO for 16 years now. Ran the CMBS desk for about a decade. More recently, as Greg mentioned, have been focused more on the private side of things, both real estate and non-real estate, focused on some of our hedge funds, private credit funds. But as Greg mentioned, grew up in real estate before PIMCO. I was with a real estate private equity shop here in New York, working for their mortgage REIT division, where we were buying CMBS B pieces and repackaging them into CRE CDOs. So any guesses how that ended?
Usually when the acronyms come out, I jump in, but we're going to leave that one. I think
valuable lessons early in my career.
Always better early in the career. Seray, what about you?
So it's my 5th year at PIMCO. I started off basically on the origination side for Seray credit investments on the private side. I've led the capital markets team on financing our positions, both on the credit and the equity side. Now I'm helping lead our asset management platform for the credit business overall on CRE. I'm actually celebrating my 20th year being a commercial real estate lender this month. So dating back, 20 years, I've done both originations on the public side, the private side, and also have done my fair bit of workouts during the last cycle and sort of somewhat this cycle as well.
Yeah, it's an underappreciated element of being an investor, I think, sometimes, especially when the cycle's lasted as long as the one that we're currently in has. Is it does pay to have seen some things break, right?
Absolutely. I honestly, it's hard to find that level of experience. One, because it's not fun. It's not a fun job to do the stress
to
workouts,
do the workout.
right?
Yeah.
But it's such a key element, especially to have in your sort of back burner when you're originating, because you know what works and what doesn't work.
Yeah. Well, and you've done the full life cycle. You make the loan, you manage the loan, take care of it when it breaks, and obviously financing it on the back end. So that's perfect. That's going to be great for today's conversation. By the way, I have met people who really do enjoy the workout process. They tend to be quite frightening. Gino.
Yeah, Gino Gabbianelli, Senior Vice President. Been with PIMCO for 13 and a half years. I actually started on the internal sales desk in this building on the 44th floor, 1633 Broadway. I piloted what is now referred to as our BDM program. At the time, it was called our hybrid sales program. I covered the Washington, D.C. and Maryland market from 2015 to 20. One of the few people to move back to New York City during 2020. Where I've been covering Manhattan wires for the last 5.5 years.
That's fabulous. And I do appreciate the detailed rundown of the address and floor of the building you work in. It's in keeping with the real estate theme of today's conversation. All right. So I think today what we're hoping to do is give advisors listening to the call a bit of a sense of the opportunity set and kind of a complicated landscape within real estate and within the broader macro economy. And really the only way for me, I think, to kind of get there is to tell the story of real estate over the last 10 or 15 years. And it's a big story. It's a complicated story. I'm going to turn it over to Russ. And just I think a good maybe framework for this is a lot of advisors and their investors, certainly not all of them, but a lot of them began to think of real estate as an investable, diversified asset class, as the private REITs were they reemerged from a kind of a renaissance process and call it mid-teens-ish. And so maybe you could just sort of walk us through kind of those post-crisis years, the rise of the private REIT, and then we'll kind of get into COVID and what's happened since then, and just try to set the stage for where we are today.
Sure. Well, yeah, I mean, starting really when I moved over to PIMCO, it was sort of a one-way street from 2009 in terms of real estate recovery, not just in, equity prices, but all the, fallout and CMBS and distressed debt. And, that was really sort of the first way we participated in the recovery would be, CMBS and debt. And then later in the decade, sort of the equity price recovery. But, strong recovery across the board. Middle of that decade, you started to see some serious distress in retail with, the rise of Amazon, the online shopping trends and the devastation that it brought to, sort of traditional malls and to a lesser extent other forms of retail. But around that time, as you said, when you saw this sort of rediscovery of the non-traded REIT, and that's something that's been around for a long time. It was more I think more of a mom and pop product before the financial crisis, but really gained steam quite quickly, and by 2020, you saw inflows that were really pushing technicals and transaction volumes in commercial real estate. They were.
Hey, well, let me. Sorry, I don't mean to. I do mean to interrupt because I did, but so kind of coming out of the crisis, I think what I heard you say was just basically asset values just massively deflated, right? More because of the banking crisis and the dislocation. I would imagine a lot of the activity for you guys back then, was CMBS trading cents on the dollar, where you knew the property, it may not be worth what it was in 2007, but it wasn't worth nothing.
Exactly.
Right. Okay. Right. The kind of the typical kind of distressed buyer set up value buyers, set up, and then it recovered, and moved on to something that was a little bit more normal. How long did that take, that recovery period?
Yeah, I'd say by 2014, 2015, most things had recovered. It was probably five-ish year process of some things snap back quicker than others, but it was by the middle of that decade, the deep distress CMBS trade was over.
Yeah. As our clients harvested interesting investments they'd made, or frankly, let's say also found themselves able to get out of investments they might have made pre-crisis, you needed to sort of put that somewhere, and I think that's kind of what drove the emergence of these non-traded REITs. And then Russ, when I cut you off, you were about to I think start talking about just how popular that phenomenon became.
Yes, you saw really an explosion in 2020 and 2021 of the product. I think for a couple of reasons. A couple of really good years of performance at the last few years of the decade, and really concerted sort of focused sales efforts. But what that led to was obviously huge inflows and huge transaction volumes, and these vehicles becoming really the bid in the marketplace, not only for all the private transaction volume, but in some cases also, taking large public companies private.
Right.
You got to do something with the cash that's coming in. So that really, really drove the market 2020, 2021, and even the first half of 2022. I mean, you still saw big, take privates even as late as spring or early summer of 2022. But, the music sort of stopped when the rate hiking cycle started.
And even before that, you mentioned retail, and then obviously during COVID, office was a huge question mark, and remains, I think, a question mark we'll get to later in the conversation. But at least the private REIT sector kind of weathered that.
Did.
Ostensibly so. I mean, it's obviously the marketing methodology plays a role in determining whether they weather that. But it continued to grow kind of throughout that period.
Absolutely, yeah.
I think one key distinction too of what was the catalyst for this growth and for the growth in the non-traded public REIT space, but for the reemergence of real estate, was that really it was the central banks and the Fed that saved real estate by lowering rates. Right? It was a time whereby, as soon as sort of the global financial crisis started, the recession started to emerge, we had similar maturity walls back then, and on far poorer underwritten real estate. A lot of leverage in the system, not a lot of discipline in terms of kind of the underwriting standards, but the Fed really stepped up in a big way, sort of buying back bonds and also post-crisis and reducing rates. And so having done workouts during that time, it's a lot easier to extend the loan when rates are inside 1%. So they're all in coupon, maybe it's 2-3%, right? Like it's just a far different time period now than back then. And the rates really helped with sort of that reemergence and the recovery of the real estate.
And one of the reasons we do as much real estate as we do at PIMCO, we've got nearly a $200 billion platform across public and private, and our opportunistic portfolios and our core portfolios. But advisors, I think, should understand the way we think about it. Real estate, it's an income generating asset, and it tends to be quite responsive to rates, right? If
people forgot that.
People forget that. Yeah. That's right.
Real estate does have duration,
And that's. I think people forget it in much the same way. Seray, your comment was making me laugh a little bit, because I'm curious, when you were working out some of those properties post-crisis, where was it in your model where the Fed dropped rates from 5 to 0%? Right, it probably wasn't in the model, right? there's
or
an
increased rates, right? It's from 0 to 5%.
Right.
yeah. Well, exactly, leading into.
Yeah.
And so so as an asset class, it tends to be, responsive to rates, and in some respects, it can look like a bond, right? It can have the features of a bond. It can have credit associated with it, of course. It can have duration associated with it, of course, which I think is kind of interesting and explains why we're as comfortable investing in that asset class as we are. But it also begins to explain some of the tumult of real estate valuations in recent years. I did before we get to more recent times, Gino. I'm just curious when you were talking to advisors. I know this is going back 8-10 years, but one of the problems I assume a lot of them had was an absence of income generating opportunities elsewhere in their portfolio. Like core bonds were paying you nothing, effectively. And did they view real estate investments as a way of generating income? Was that a primary usage?
Yeah, I think that's a primary usage, and at the time, pretty significant premium to what you were getting from public fixed income markets.
Yeah.
I think looking under the hood and with the benefit of hindsight, that retail market, it was kind of like the first soiree into exposure to both public and private real estate markets. Maybe not the first, but I think in a broader sense, and with the evolution of different vehicles and access there. Fast forward to where we are today, you have, let's call them stretched or fair valuations that haven't really met, that have been tested to some extent, depending on the manager or the specific asset class within commercial real estate. And I think those liquidity provisions, when promised, can fall in a hurry, subject to board approval. And I think that was a pretty big learning experience for a lot of advisors.
There's a moment in time where some of these wealth-oriented vehicles really were producing terrific income relative to what was achievable in more traditional markets. But like a lot of things that you can have too much of a good thing, which I think Russ was kind of getting at as well, and saying that these vehicles grew to kind of be the market, right? And then I think everybody knows where the next part of the story is going, right? We make it through COVID. We have a big rate drop and recovery in 2021, but then 2022 comes along, and I'll let Russ and Seray kind of continue the story from there in terms of developments of the real estate market.
Yeah, I mean, obviously we saw the inflation prints that year and a pretty strong response from the Fed, kicking off probably the most intense rate hiking cycle that I've seen, that we've seen, and how the real estate market reacted to that was not ambiguous, not benign. It was obviously a pretty violent reaction.
Measured by what? Like where did you see in the real estate market the reaction to
rates? And we'll just put office to the side because that's its own sort of idiosyncratic thing.
Sure.
But,
okay.
You just take something like multifamily, which had been trading at extraordinarily low cap rates in the high threes in certain markets.
Let's talk. Actually, let's pause for just like 1
Sure.
second. Cap rates, because again, I think almost everybody listening, to the podcast is familiar with the term, but maybe some of their clients may not be. Let's talk. What's a cap rate, and how is it sort of relevant to the valuation?
Yeah,
of a real estate asset?
it would just be your yield on the asset unlevered. So your income produced by the asset divided by the purchase price. So if you're buying at a 4% cap rate, you're going to expect to achieve a 4% return.
I pay you $1 for the building, and you pay me 4 cents in rent.
Exactly.
Right?
Exactly.
Right. The lower the cap, the more expensive the asset.
Exactly. And so, if you go from a 4 cap to a 5 cap, that's meaningful.
Yeah. And how does that relate then to the overall rate environment?
Yeah. So as rates started going up, people look at themselves and say, why would I pay the same for real estate when I can go and get 4 or 5% in treasuries? They should go up. Your financing costs goes up, which drives cap rates up as well. If you're in a situation where you're not looking at extraordinary rental growth potential, which could hold cap rates down, then cap rates are almost certainly going to be moving up when you see a rate regime change like we saw in 2022.
Yes, like all things being equal, if the prevailing rate goes up, cap rate should kind of go with it, some kind of risk premium.
Right.
Like you've got to believe either that rents are going to go way up, or the value of the property, like something speculative.
Exactly. Take data centers right now. There's enough growth being, built into, income, lease rates for data centers that you could pay a low cap, or you could have a lower cap today than you did, a year or two ago.
Right. Okay, perfect. Okay, so, sorry, I interrupted you, but we went through a little bit of tutorial on real estate. So cap rates.
Yeah, so cap rates went up. Values dropped really across the board, but you saw probably more pronounced moves in the areas that had the lower caps going into it, such as multifamily, and again office on its own sort of island out there, with its own idiosyncratic issues, but obviously experienced, pretty profound drops as well. Retail, kind of oddly enough, got dinged up enough a decade earlier that it has actually been, I'd say, an outperformer over the past 5 years, even through COVID.
Right.
COVID was weird. It was, and Seray can jump in here too with asset management, but like, the cycle in real estate was the 2022 rate hiking cycle. COVID was not a cycle. COVID was like a timeout, where everyone said, just give me 3 months. And, you were a jerk if you didn't give someone 3 months, whether it be a shop owner or
a rent relief.
A hotel.
Right.
Everybody was giving everybody, a timeout across the board and sort of the economy. So you didn't really see a whole lot of, real action being taken on, by asset managers, and you sort of snap back, pretty quickly.
So coming out of COVID, office was really kind of, that's where we feel the longer term effects. But you think most other sectors, a year out of COVID were doing great. Right.
Yeah, I mean, high top tick, all-time highs.
Yeah. From a fundamentals perspective, I mean, you saw industrial with, 13% year-over-year rent growth. You had, 5-6% rent growth for multifamily. You had the COVID bump outside of COVID, with hospitality really picking up a lot of momentum. Revenge travel. So from a fundamentals perspective, pre-hikes, real estate had, for the most part, recovered. And really, you had peak origination volumes, both on the private side, on bank balance sheets, and on the public debt side, leading up to sort of what spurred from the Russia invading Ukraine and then the rate hike cycle starting. So 2021 was peak origination and transaction volume cycle for real estate.
Right, just this Goldilocks situation for most of real estate: low rates, high transaction volume, and we weren't aware of the impending inflationary experience we were all about to have. And then as rates have come up, there's the math you were doing, Russ, right? Which is like very, very simple. If the prevailing rate's higher, then the value of anything that produces income is going to be lower because my risk-free rate is higher. But when do higher rates kind of spill into the fundamentals of owning buildings, right? So it's not just that they're worth relatively less than they might have been before the rate hike, but many owners of real estate are levered owners of real estate. So let's talk about how the structure of rates influences that.
Right, that's where it comes from, is the leverage. I mean, in theory, if you were an unlevered holder, it wouldn't necessarily affect you. Again, outside of office, if you're just owning an industrial, with some long-term leases, you're fine, right? If you can hold through this. But when the debt comes due, that's a different story, and that's what we've seen really driving most of the distress in this cycle is due to refinancing and refinancing into rates that are a good 300 400 basis points all in higher than what you would have taken out in 19 20 21.
Right.
So that's the fundamental challenge that a lot of borrowers are facing right now.
How this is a really open-ended question. You guys answer it however you want, but like how do most real estate owners borrow against their assets?
Through a mortgage?
I meant a little bit more. Do they tend to be fixed rate, floating rate, longer term or shorter term?
The more traditional way is fixed. That's more sort of stabilized LifeCo, and even I think even more the smaller balance. Fixed is probably a little bit more common, where floating is more common in the trend, what we call transitional properties, so properties that have a story, have a business plan, are need to be stabilized.
Gotcha. It's kind of that core concept we were talking about earlier, right? A building that is kind of in its final state, it's fully leased up. The next 20 years of its life cycle are fairly visible. They borrow in the fixed rate market. Sometimes you buy an office building in downtown Manhattan, and you've got a vision to turn it into a boutique hotel and a pickleball, gym downstairs, and and maybe a club on the roof or something like that. That's more of a story, right?
Exactly.
That's right. So then you borrow for like 3 years.
3 year, floating rate, and then when you've proven out the business plan, maybe refinance longer term into a fixed rate.
Yeah. So when we think about those maturities, some of that, the fixed rate stuff that they borrowed 5-7 years ago when rates were really, really low, that's coming due. And then a lot of this transitional stuff as well, kind of coming due right now, basically, with rates still sitting pretty high.
Exactly.
Right.
Yeah.
I mean, what essentially made matters worse for real estate borrowers has been that they borrowed when values were really high, and they're refinancing into a market where, one, values have dropped. So there's a natural refinance shortfall between where the value was before and the 60% leverage and where the value is today and 60% leverage. Rates are higher, spreads are higher, although they've come in quite a bit since the peaks.
Mm-hmm.
So there's a debt service coverage shortfall, meaning the property, the NOI, the net operating income, the cash flow generated from the property is not sufficient to cover the debt service under the loan, and that's been the key issue with these maturities and the refinances.
Which then requires somebody to do something to get more cash into the deal, right? Whether it's the owner
or third-party capital coming in to save the day.
But you've had these little nuances too that I would say most people aren't aware of unless you're in the weeds and borrower or lender, where you think you have a 5-year floating rate loan that you took out in 2020, I'll deal with it in 2025. But in 2023, you've got to buy a rate cap that you bought in 2020, right? So you buy a rate cap, and what does that mean? It means if rates were to increase above, say, 3%, then a bank's going to basically step in and cover that. So you outlay an initial payment up front to protect yourself from
a little insurance policy.
Exactly.
Yeah.
But that expires, and then you got to buy back in, and at a time when rates are much higher and interest rate volatility is way higher.
It's like you took out a life insurance policy when you were 18 and in the prime of health, and then you had to re-underwrite it when you were middle-aged and sedentary, and were shocked to find the premium was quite a bit higher, right? Yeah. So all that's sort of happening as we speak, right? I mean, and sort of working its way through the system. You tell me if I'm wrong. It doesn't sound like it's been calamitous. Quite the opposite. More of a slow-moving workout situation. Am I wrong about that?
No, it has, and there's all these phrases that, stay alive to 25. There's been all this, optimism from borrowers that the Fed would have lowered interest rates by now.
Right.
And every time, we get a rate rally, it feels like we then, take a few steps backwards, and, you may buy a little bit of time, and then, and then the lender tightens the clamps again. So it's been sort of fits and starts, but I would say we're sort of getting to the end of a lot of the rope that lenders have been willing to give. But Seray's probably in a better position to talk about that than me.
I think So I think the key phrase.
Are you extending any rope at this point, Seray, or are you pulling it back in?
Depends on who it is. So I would just say patience is running out.
Yeah.
So the financing market, sort of to your earlier question, this is a very bank-driven market, right? 50% of the Seray credit extended is from banks. So how they behave in this market environment is really important to the distress that you see in the market and how borrowers behave. And so what transpired over the last 2.5 years, sort of since the rate hikes, has been that lenders were patient for a few reasons. One, to Russ's point, they had rate caps in place, whereby the debt service coverage was still in a healthy level. So even though rates rose to 4.5-5% on the floating rate space, they had rate caps.
They had an adjustable mortgage, and it was coming,
yes,
right? Yeah.
Exactly.
Yeah.
So then the amount of capital that they have to hold against worst risk-rated assets becomes higher and higher as the risk rating goes up. The banks, right? So now this loan is really literally burning a hole in their pocket because it's really becoming costly to carry this loan. And so they're starting to force the issue on their borrowers to say, I need to get paid back, or else I'm going to exercise my remedies. And so that's where the borrower actually has to do a forced transaction, whether it's through selling into the market, but at a distressed level where they're seeing their equity eroding, or they're refinancing, to Russ's point, at much higher spreads at lower leverage points, and there's a shortfall. And somebody has to fill that shortfall. And if the borrower doesn't have that liquidity, they're going out to the private capital space and borrowing that money. Right.
But with fundamentals intact, it could make economic sense to borrow at a higher rate, maybe decrease leverage, in the same way that, if your credit card rate goes up, you might run a lower balance, just to keep your monthly payments in check. But maybe that's too tortured an example. I see Russ looking at me like, but if the fundamentals of the building are intact, it can make sense to do that. It's just a question of when are you pushed into that position to make that tough choice, right?
That's right. And then if the cash flows can really support it. Given the negative carry, at some point you run out of fuel, right? To continue to put in cash flow. So what we've seen,
if your rent is not paying your interest payments,
that's
your negative carry.
And so you can only come up with cash for so long before you just simply run out of it, and you run out of choices, and then you go back sort of into the market.
LPs aren't in the mood to re-up right now, especially if you're in a longer term sort of locked up.
So what you guys are talking about, it's this really, it's a microcosm, but it's such an interesting. It's true in so many places, I think, of the economy right now. We hear it from clients a lot, which is, you said it nicely, Seray. Patience is running out, in the sense that maybe the banks don't want to continue to hope, right? They've run out of options, and somebody's tapping somebody on the shoulder, and something needs to get done. Russ, to your point, the LPs in the real estate private equity fund that bought the building 5, 8, 12 years ago, like the fund is over. The expiration date's come and gone, and they still haven't liquidated the property, so they're less eager to to extend. And when that happens, it tends to force something we call price discovery, right? Which is when prior to that, nobody needed to know what the building was worth because you had like a status quo that was just moving along. But if somebody's going to put new equity in, if somebody's going to make a new loan to the building, or somebody's going to sell the building because their LPs need them to, want them to, strongly encourage them to, then you need a new price, right? And I suspect that's something that makes you both as investors kind of excited about the next few years.
Yeah, of course. I think that we're getting close to actually seeing some decent transaction volumes, but we really haven't seen that uptick yet. But I do feel like it's coming, and yes, we are very excited about it. Both on the equity side, but also on the lending side, seeing more transaction volume will mean more lending opportunities as well. Which we've frankly been spending more time on the lending side because we think the relative value has favored being a lender the past 2 or 3 years while we sort of wait for a bottom. But we could do more, and more transaction volumes will mean more lending opportunities as well.
I do want to talk about what you just said, Russ, which is you sort of prefer to be a lender right now versus the equity. Is it a good time to lend? Is it is there enough volume out there? Are borrowers rational and reasonable about terms and pricing at this point? Is there a gap of capital that we feel like we can play a role in filling?
Yeah, I think it's a great time to lend, and the main reason is we've experienced a 20-25% drawdown in prices, and the basis that you're lending against is that much lower. So doing a 65, 70, 75% LTV loan where prices have already corrected by 20-25%, and you've got another call it 25-30% subordination, that feels pretty good. And I think historically that's a really good spot to be. You layer in the fact that we're sitting call it 4.5-ish%, plus enjoying still pretty healthy spreads as well without taking a whole lot of risk.
And before leverage.
Exactly.
Yeah.
That's something we haven't seen in a very, very long time.
Right.
So really, really, really good risk adjusted return.
Hard asset backing,
exactly.
Underwritable cash flows, existing asset, right? Yeah.
I mean, I think what we're seeing now is a pretty rare phenomenon. I mean, I'll go out and say my 20-year lending career is probably the best time to be a commercial real estate credit lender, right? So where market fundamentals are normalizing at the real estate level, but there's still a market dislocation on the capital markets level. And with the pressure from this maturity wall that everyone's talking about, and that coupled with sort of the bank retrenchment story, it just creates this abundance of opportunity to step into the space at lower leverage and really robust yields.
I had wanted to maybe talk about a few sectors because I'm super curious. But let me, Gino, is there anything you think is on advisors' minds right now that we're not hitting in this conversation yet?
Not that we haven't hit, but maybe to drill down a little bit on because the maturity wall conversation has certainly made its way to wealth. It's something you're seeing in headlines a ton. How should advisors be thinking about that in terms of existing allocations that they have versus, say, a fresh balance sheet with a pretty well capitalized investor or buyer?
That's a great question. I think that it's fair to say that any vehicle that was fully invested in 21, 22 is probably still feeling some sort of valuation pressure, and just the way that these things work with I think the appraisal cycle, there's lags. There's always lags, and so investing now with a clean balance sheet, post the valuation adjustment, it just feels like it's a little bit too easy on a relative basis between a pre-22 balance sheet versus a post-22 balance sheet. It's just I don't think those things could in any universe sort of be equal.
What do public market valuations of REITs sort of imply relative to their private counterparts? I mean, at one point that gap was 25-30% valuation difference. I think it's closed.
Yeah, it has, because we saw a decent rally in public REITs last year, but it's probably still low double digits, sort of 10-ish%
right
gap between some of the larger private REIts that just never really adjusted.
Yeah, and you don't want to generalize too much, but it's you've got a public market equivalent trading at a 10% discount to a private market. That's a rare phenomenon to see the liquid tradable vehicle at a discount to the illiquid, less tradable vehicle. So it's certainly something for advisors to kind of factor into decisions. Do you guys think, in terms of sectors, are there? I was laughing to myself because you can hear the construction outside our window. I don't know if it's made its way into the mic, but that's obviously, like, supply is also a huge part of how you think about valuation, right? If you'd pay a lot less for a building if a carbon copy of it's going up next door, right? And so, are there areas where the supply demand dynamic you think looks particularly compelling or not compelling right now?
Yeah, I mean, I can start off. So, I mean, from a multifamily and industrial perspective, those were the two asset classes that got hit hard from new supply delivering, especially rolling out in 2024, 2025, and 2026. But demand has really kept up. So when you look at fundamentals, yes, industrial is no longer printing double-digit rent growth, but it's still printing 4 or 5% rent growth,
right,
which is
keeping up,
which is quite strong. But if you look at the supply pipeline beyond 2026, it drops off a cliff. And when you think back to why that is, that's because construction lending essentially dried up, post 2022, with everyone retrenching and worrying about their existing portfolios.
Mm-hmm.
So from a supply demand perspective, it actually is set up really for success, right? And then just sort of other markets, right? Office, there's too much of office. The work from home trends have surpassed anyone's expectations. And so you're now seeing a lot of office coming offline in terms of whether they're being converted to residential or hospitality or, life science. Now, another sector that's been really hit hard by new supply delivering.
Life science has.
Science has.
Oh, interesting. Okay.
Yeah.
Because that was a darling. I mean,
Yeah.
I'm dating myself, 4 or 5 years ago. I mean, that was.
No, it was.
I guess that's the theme of your whole conversation.
Yeah.
So, I mean, a lot of office landlords, thought, well, there's this work from home. No one needs my space anymore, but there's this growth in the life science sector, so let me convert my space to life science. And so some of those submarkets have seen, double the amount of supply.
Is that an easy conversion? I mean, sometimes these things become very
costly conversion.
It's a costly conversion.
Very
okay,
costly.
Yeah, the build out in life science is pretty intense.
Before we wrap things up for this conversation, which I've really enjoyed with both of you, Gino, from the advisor's perspective, anything else that we ought to cover?
Yeah, I think as you think about the evolution of product that's been offered to advisors over, call it the last 10 years, I think historically you've had either equity exposure, specifically if we're talking in the private space, or debt exposure, Rarely do you have both. I think what's been interesting about our platform is the focus on high occupancy, high quality, core stabilized, but the ability to go both not only private and public, but into debt and equity. Is advisors are kind of sifting through products on their platforms. Seray, Russ, I'm curious to hear how you would encourage them to think about the flexibility within product. Is it better to be in kind of an asset specific type of product or one with flexibility, or yes or no to both?
I mean, I'm all. It's a great question. I'm always an advocate of if you trust your manager to make those relative value decisions, then the flexibility is going to pay off. And you think about a time period like COVID, where, say, if we were focused primarily on private markets going into that, as soon as we see things start to break and it the ability to become a liquidity provider becomes very compelling. And you think about the markets that break, or obviously the liquid, the public markets, something like CMBS. What we would do and what we did in that time period is put all of our private deals on hold, either just say, I'm sorry, come back to us in a few months, and focus all of our attention and all of our marginal dollars, dry powder, what have you, on addressing that which is broken and which is immediately sort of actionable. That's the thing with the private markets in a time period like COVID. There's nothing to do anyway. Everyone just sort of goes home. Transactions either freeze or fall through. And it's not like private papers flying around down 20 cents like the way it is in CMBS. So if you've got the piping and the plumbing built into the product, you might as well utilize it, because we can, at the snap of a finger, turn around and, one morning be deploying into CMBS market, a few hours later, So I think that's enormously beneficial for a client, because even if you wanted to sort of do the allocating yourself or at the sort of advisor level, you just don't really have the time to get your ducks in a row to go find a strategy that's going to take advantage of, a CMBS dislocation, where prices have dropped 30 points in a week, right? It's just, you kind of got to have everything built in to one product. And that's what we try and do with a lot of our, not all of them, but a lot of them. And any time we can build in that flexibility on behalf of our clients, that we do. And for the most part, our clients have, sort of enjoyed the benefit of that.
Yeah. I mean, I think just to Russ's point, in today's uncertain economic environment, traditional drivers of equity real estate value is just less predictable. So you have to have a nimble platform. You can't rely on sort of these beta bets on asset classes anymore. So you have to sift through the market to find alpha. So that could be on the senior loan space, that could be in pref equity, or that could be in equity, or it could be in public versus private markets. And I think given the robust platform that we have with professionals working in all four quadrants, it makes it pretty interesting environment that this volatility has created to sift through the opportunities and pick sort of where we think the highest risk-adjusted returns are.
All right. That's terrific. That's awesome. Thank you both for joining Gino and I here to record this, and on behalf of financial advisors who listen to and work with PIMCO. That's it for today. Thanks again for joining us for Accrued Interest. Let me just make a couple of notes here. First of all, we did just publish our real estate outlook for the coming year called Bend Not Break. We'll put a link to that in the show notes. Russ has actually authored a piece along with a few of our other private credit or private asset focused portfolio managers and product specialists here at PIMCO, which we'll link to as well, which gives an even higher top-down view of what's going on in those markets, particularly on a relative value basis compared to public markets, which we're excited about. As always, we would encourage you to do a couple of things. One, please go ahead and subscribe to the podcast. That helps us know that we're reaching you, financial advisors. It helps us guides our programming decisions and make things better for you and more valuable to you and your clients. Do visit us at the PIMCO website. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum. Advisor Forum is your destination at PIMCO for the material that you need to get your questions answered quickly and efficiently and provide you with the tools and the expertise that you can use best to help your clients make good financial decisions. The next time that you hear me will most likely be, I like to say most likely because you never know what the market's going to throw at you, but our next episode should be coming up in a few weeks. It will feature Mark Seidner talking about the latest PIMCO Perspectives piece. In the meantime, best of luck in your practice. Enjoy your summers. Please take time off to spend with family and friends, and we'll look forward to speaking to you soon.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures